We're back. Back in action to talk about the real estate market.
Ooh.
So, we had said, we hadn't done a video in a while on real estate.
Right.
And yesterday, I started The Big Short, which is on Netflix right now.
Oof.
Which, as you know, is about the housing crash, right?
Yes.
In 2008. But in seeing some of I've seen it several times. But so many things in that video where they're highlighting what happened and how Michael Burry shorted the mortgage-backed securities and the housing market. So many things seem very similar to where we are right now.
Wow.
And this video is being done September 1st of 2023.
September 1st already. The year has... Unbelievable.
So I'm really interested in your take because you've been an investor, you've been in the real estate world for a long time, decades. So you've seen different cycles, different, right, highs and lows.
Oh, yeah.
I haven't seen the same amount, but I do remember 2008, I was 18 years old. I remember the situation, but I wasn't participating.
Mm-hmm.
We try to be positive people, and a lot of things on YouTube and other channels, but we're on YouTube, are clickbait, the housing crash, the housing market. So I would want to stay away from that kind of like alarmist type of thing, because people have been talking about a housing crash for how many years?
Long time. Long time.
However, you just said something very interesting about Michael Burry.
Mm-hmm. Yeah, from what I understand, he just, I think he just shorted the market to the tune of $1.6 billion. So he's expecting the stock market to take a huge hit in the next 6 months or so.
And this is the guy who shorted the real estate market.
It's a scary thought.
In the movie The Big Short, which is an excellent movie,
Uh-huh.
I really like it.
Uh-huh.
They portray everybody around him was questioning him, calling him crazy, because the safest thing was
mortgage-backed securities.
The safest thing was a bond that was backed by the housing market.
Right. Okay.
Right, a AAA rated bond, and then he actually read the paperwork and he noticed that these bonds that were being rated AAA were actually junk bonds. And so, but they were packaging them all together nicely and selling it as a mortgage-backed security.
Yeah. And the thing that I find amazing is that sometimes when I talk to people about 2008, they think that it just affected the United States of America, when in reality, what happened in the United States of America affected the world. And the reason it affected the world is because you had people in Scandinavia and stuff like that. I think I remember reading about a school or a retirement program for teachers or something like that in Finland or Sweden or something like that, investing in these packaged AAA, okay? And when it went down, they went bankrupt. So I hope I'm not giving, but that's the idea. So this wasn't only a United States thing, because everybody in the world was investing in these things, and so we all went down with these debacle.
Everything's connected. I mean, to the dollar, the U.S. So I just looked it up. So we'll link it on the description, so it's there. But Michael Burry's $1.6 billion bet against the market is now down this much. So, and what's interesting is that he actually created, at least the way the movie portrays it, he created this type of investment to bet against the housing market. It wasn't an existing investment.
Oh, that's right. I need to see that movie again. That's right.
He had to convince the bank, and they were laughing at him in the movie. Okay, you want to give us free money? This is Wall Street, one of the ladies at Goldman Sachs said. And then I know it's a movie, and so there's pieces of it that I'm sure are a little bit.
It's a great movie. I'm going to watch that again.
But one thing in particular was that they said, okay, we'll do this investment, but if but you have to pay us, because one of his things he said at the bank, he said, look, if you're gonna create this type of investment for me, um, I want to guarantee on your ability to pay me back, your solvency, if the bank goes insolvent. And they were laughing at him, and then they said, you're what are you talking about, or Goldman Sachs. And then he said, no, I just want to make sure. And they said, okay, we can pay you, like create a payment plan, because they were going to owe him essentially a lot of money if he was right.
Right.
And then they said, but it's going to work the other way too. As the price of these mortgage-backed security increases, you have to pay us. And it got to a point in the movie where the guys at Scion's like, you're crazy. How much are we paying? Because the securities were still going up, the mortgage-backed securities, but there were defaults occurring in the market. But the rating agencies were not lowering the rating of the bonds. So
they were squeezing him.
And so they were actually, he was paying, he's like, we're paying about 80 to 90, I think he said like 70 to 90 million a year. He had to pay the banks, Deutsche Bank, Goldman Sachs. He had to pay them because the securities were still increasing, even though defaults were happening. So he was saying in that piece in the scene, hey, 2007, I don't know if it was spring or that's when we're going to see that the mortgage-backed securities are going to begin to drop. But it hadn't reflected yet. And part of it was because, and in the movie they make it seem like the S&P Standard & Poor's rating agency was actually, it's like, let's bring it to, was actually disincentivized to give them a bad rating. And the example that came about in the discussion with my wife yesterday was, you have an appraiser who gets chosen by a bank. It's supposed to be a third party when you're getting a loan. But if that appraiser doesn't give that loan at the value, if he comes in under or she comes in under too much, will they get that job again?
They'll potentially kill that deal, develop a reputation in the industry that, hey, this guy, it's a deal killer, and he won't get another. Potentially he or she will not get, another. Yeah.
And that's what the movie was saying about the rating agency. If we don't give them the AAA rating for these bonds, they'll go down to Moody's, which is another rating agency on Wall Street, and they'll give their business to them. That's what was happening, according to the movie. It's very interesting.
It's very interesting.
So, all of that
because
said,
then how do you trust the rating agencies?
Right.
If they're not, if they're rating a company, right? Let's take anything, insurance company, right? And they're giving it an A+ rating because they're afraid that they potentially will lose the deal because they're going to go to the other rating agency.
Right.
Then the integrity of that rating company
is questioned.
Yeah, for sure. And it's happened.
Oh.
It's happened.
So, so why are prices so high right now?
Well, inventory is extremely low.
Yeah.
And the people that I think are buying today are the people that kind of have to, okay? Mixed along with some investors, okay? And so what ends up happening is that everybody refinanced at a very low rate, and they're sitting on that low rate. But that now has become, they call it like the golden prison. Because
golden handcuffs.
Handcuffs, because what happens is the rate is so low, who's going to leave a 3% rate to go to a 7.5 for, if you're an investor or even an owner-occupied? Some of the rates were at 2.8. Some people that I know got 2.8. I think they had mentioned it was the lowest rate since the Eisenhower administration. So can you imagine? That was very, very, very cheap money. So I know a couple of people that they refinanced everything they had and pulled money out. And so they're standing by the sidelines with money that they pulled out at 2.8%, 3%, 3.2%, 3.5%. And then all of a sudden, we have the fastest increase in interest rates in the history of our country. So we have the fastest rate increase in the history of our country. So it took everybody by surprise. So
Yeah.
you've got these revolving door kind of loans for investments and corporations and stuff like that. They're all coming due at the higher rates.
You're saying revolving door? Are you talking about like adjustable?
Yeah.
Or these 3-2-1 or these different?
Yes, and corporate financing. You know, you have a corporation that's growing and they need to borrow money, and they borrow money for a period of time at this amount.
Short periods,
Yeah.
maybe 5 year,
Yes.
2 year.
Yes, and so you know, when this come due, okay, now you got a higher interest rate. So who's going to end up paying for the additional cost? And the answer is always the same one, apparently, and that is the consumer. Because the cost is going to get passed down to the consumer.
Right.
But why are real estate prices so high? Inventory is very low, and even though you have fewer people looking for properties, because inventory is so low, those fewer people end up being quite a bit. And so you've got like a bidding war. With the other day, we saw a property in Burbank. It was a pretty good deal. Our investor offered more than what they were asking for, and they didn't take our offer because they wanted to wait to see what everybody was doing, and they ended up getting 22 offers. 20 offers, 22 offers, something like that.
Yep.
For that particular property, and it went way over
And this is
the asking price.
This is a duplex.
This is a
2
duplex.
units.
2 units. And even though we were the first ones to make the offer and overprice, we didn't even get a counter.
Right.
They only countered the 7 highest, which according to the realtor, without giving me figures, it was much higher than what we had offered, and we offered overprice, over asking.
So the way I see that is there's a lot of people, like you said, there's still a lot of people, so a lot of demand, not a lot of supply, which is economics, and then so the price increases.
Yeah, but the first-time buyers are priced out.
Yeah, I read something the other day that like something of, you see these articles, it said something like 40% of young home buyers are getting assistance from their parents to buy
How
a
else
house.
can they do it?
Yeah.
Or
know,
you got to get super creative
you gotta get super creative.
in dealing with the owner themselves and figure out a situation where everybody can win. I love carrybacks. But yeah, go ahead. So what?
Well, so what's gonna happen? Because so Michael Burry making that bet against the market, but not the housing market. He's betting against, is it the stock market?
The stock market.
The stock market.
He's saying that in the next 6 months, the stock market is going to crash.
I mean, I look at the stock market every day, just to look at it. We're still at 34,000. The Dow Jones is 34,000. The Nasdaq 13,009, and the S&P 44,500. The Dow Jones, I think at one point, not too long ago, got close to like 37, maybe 39,000, but we're still at 34,000.
Yeah.
Yeah. If I were to look at,
But is it sustainable? Because
it got up to 35.
35, okay.
Yeah, it got up to 35, and that's the highest it's ever been. 36 was November of 2021, but since then it hasn't.
Yeah,
35.
but from 35 to 34 is not that big.
It's not a lot. That's what I'm saying. I mean, it peaked in 2021, and it really hasn't. So
It's a very bold prediction, but the man was right, in 2008 and everybody in the world was laughing at him. So, it's like they're saying nobody's laughing now. In fact, some people are somewhat leery.
So I'm reading here, it says he bet against the stock market, particularly the SPDR S&P 500 ETF Trust, SPY, and the Invesco QQQ Trust, QQQ funds. So I would want to look more into this. If this is those are, when I hear S&P 500, I think of like that's supposed to be a very stable,
Correct.
the top 500 companies or so in the United States, supposed to be like a solid index. So he bet against that, which is similar. He was betting against the mortgage-backed security, which mortgages were supposed to be a very solid, stable investment.
Correct. It's and you got to pay attention to the guy. Like they say, history is no guarantee of performance, but he called it. Can he call it again? And he's a numbers guy. Apparently, he's exceptionally bright. And for him to bet $1.6 billion against it, that raised some eyebrows. I guarantee you. The article I was reading was very interesting.
Yeah.
And so, and you're saying, okay, that's not real estate, but that's going to affect real estate too.
Oh, yeah.
Because,
absolutely.
Yeah, and there are other things. Like, for example, in this particular offer that we made, there was a house in the front, right? So maybe you had somebody that wanted to live in it, okay? And now you've got an owner-occupier, which potentially will offset, if they have money, an investor can compete. Because now that's a property that you're going to live in. So that brings in a whole set of different factors. You got someone that's willing to pay a lot more because they're going to occupy that property with their family. Maybe they're looking for newer schools or different schools or whatever, and they like the schools in the area. And boom, here you go. So the investors are wiped out. And from the beginning, the first-time buyers are also gone because the rates are, not only the rates, but the prices are high.
But we've also seen investment property that there's a lot of people that have cash making offers on investment property that just want some sort of income, whether they want to take it out of the stock market,
right?
Whether they want to take it out of the bank, for whatever, they just think, oh, let me put it in these 4 units, 3 units, duplex, and at least I'll have income. But what was very interesting in The Big Short was that these people were walking away from their homes because they were underwater.
Right.
And in the movie, they specifically go to Florida, and they knock on a door about on a property that was delinquent, I believe, and the person comes out, and it was a tenant, and he says, "Hey, I'm looking for this person's behind on whatever," and he says, "I've been paying my rent." The tenant says in the movie. So the idea there is that he's paying the rent, the landlord's pocketing it, and it wasn't paying the bank.
Right. Because the value of the property had dropped between $100,000 to $150,000, $200,000 potentially below what he had paid for. So just think for a second. You have a loan for $400,000, okay? And your property now is worth $200,000. And why do you have a loan for $400,000? Because you had all these no down loans and 2% down loans and 5%. I mean, you could get into a property with hardly any money down, and supposedly some people were telling the clients, hey, don't worry about it because the market is appreciating. So in 6 months, you're going to have another $50,000 in equity, even though you only put $3,000 to get in. Everybody was doing it.
Also, the lending practices, the no income, no job verification,
right?
Stated income, adjustable loans, and in the movie they were, again, it's a movie, But The Big Short was saying, hey, these lenders were like, or it was somebody they were interviewing saying, oh, my lender told me I could just refinance out of this arm, this adjustable loan. And I've heard that a lot in today's market. Lenders saying, just refinance it down the road, pay the 7.5%, 8%, whatever, and refinance it. And I don't know. There's several things that just seem similar.
That's very interesting that you would say that. Now you got me on a different thought wavelength kind of thing. I'm gonna look at the movie again.
Yeah.
And then see if I can apply some of it like you're doing to current market issues. But what I see is this sustainable? And my humble 2 cents is, no, it can't. Because the only people that are buying are the people that have a lot of money.
Cash.
And they can throw it out there. Because if you're trying to do the numbers with the loans at the rates that they are today, the amounts are not sustainable. How do you do it? And the other thing is that I don't think that the increase in salaries on jobs, okay, are matching. They're not, okay, and so you can have. It used to be that one working spouse, could get the property. Then, in order to move forward, you had to have 2 working spouses to get the property. And now it seems like those 2 working spouses have to have 2 different jobs each in order to, So, how much more can we go? How much more can we push the family unit? You got 2 working spouses, both of them working, right? And both of them have 2 jobs each in order to meet, So it's rough.
So what? Because I had a good buddy call me the other day and say, where should I invest? And I said, well, me particularly, what I'm doing is I don't have my money in the stock market anymore. I did.
Mm-hmm.
But I pulled out, July of 2022. So the majority, I have little things here and there, but for the most part, I'm not in the stock market. Is the housing market, is real estate a good place to invest? It seems like a more secure thing than the stock market, but everything has risks, right?
Everything has a risk.
Everything has a risk.
I sent you a short clip of someone, I believe they're in Florida, and he's being filmed very quickly, and he's talking. He called his tenant, and he says, "Hey, you're behind 2 months. I just want to see if we can work this out. You can pay the rent." And the guy flat out told him on the phone, "Hey, listen, I like you. You're a good person, but I'm not going to pay the rent. So see what you can do. I'm very sorry." And he says, "But what do you mean? You signed a lease. Okay, I'm going to have to evict you." And the guy said, "Well, I know you and I both know that the process of eviction takes a long time and costs a lot of money, so you're not going to do it.
Wow.
So I'm just going to sit here and not pay." And so what does that investor do? Especially if that investor, that's his only sole property where he bought to try to make some money.
And if he's got a mortgage on it,
And I'm sure that he does.
who's going to pay it?
Well, he's going to have to do it or declare bankruptcy because you got a tenant.
Or sell the property. But
Good luck.
good luck, because now you're buying a property with a tenant who's not paying.
Who's not paying?
So who's going to want to buy that?
It's,
An investor who buys it at a discount.
right. But how low can you go? If you have to cure whatever loan there is on it. In other words, what you're seeing is the evaporation of the small businessman down payments.
Investor.
Yeah, the small investor down payments. The guys that are the hardworking people, and it's gonna bite all of us eventually, right? So we need to find a way out of this. And I think that the way out of this is somehow to control the rates so that we could come down to something more amiable in terms of rates so we can stimulate the market.
But the prices would not, if the rates were to drop, the prices would not drop, right?
Yeah, I don't think prices are going to drop.
Or if rates drop, then that person who's on that 3%, 4% might be incentivized again to sell because they're still going to get a 3, 4, 5%.
Look, what I'm seeing, okay, so this is a complete turnaround from what I thought. I thought that if you would have talked to me a year ago, in fact, I told our friend George, we have a lot of discussions, he thought prices wouldn't drop. And I said, oh no, I think you're mistaken. The one that was mistaken was me. I was wrong in the prediction because we've been having this conversation with George for maybe a year and a half, 2.
Yeah, a couple of years.
Yeah, a couple of years. And I said, hey, you watch, in 6 months prices are going to begin to drop. Well, I was basing it on the fact that I thought foreclosures were going to increase, but prices have not dropped. Au contraire.
All that much.
Well, in some
areas, it seems like they've come down a little.
But you're looking at, for example, Burbank, that property in Burbank, in North Hollywood. These prices are they put them on even La Puente. Remember La Puente?
Yeah.
She puts it up. These were 3 units for 1.24.
Somewhere around there, yeah.
And she got 5 offers higher than asking price. We're seeing again higher than asking price. The lady was shocked.
Now, it could also be the marketing strategy of the agent. So, for example, the 2 units at Burbank, they knew they put it really low.
They put it low. Mm-hmm. Yeah, they did.
They did that to get over 200 people to go look at the property.
That's right. So, they had 200 people come. That's another thing.
So that was done. But had that person priced it higher, they probably wouldn't have had that many people come. Still, maybe they would have ended up with a lot of offers, but 20 offers. And this is California, which is
so they had 200 people. That's 10%. 10% of the people.
10%.
And they only counted 7 out of the 20. And we offer more than asking, and we didn't even get a counter. That's how far off the others were.
That's how high they went, yeah.
That's how high they went.
Because that's a bidding war. That's a bidding war. So an investor, from what I'm thinking is like, these investors, some of them might be investors, some of them might be owner-occupied. They don't have that many options, and they're getting a little desperate. They want to get their money out of the bank for some reason. Because remember, not that long ago, we had these banks folding.
Yeah.
Silicon Valley Bank, the one in New York. There was another one.
Yeah, a big one in New York, yeah.
So they were just bought out, kind of put to the side, and we don't hear about that anymore.
Right, but see, that's millions and millions of dollars in default. Who's paying for that?
What happened to
the
all
loss.
that debt? Because those were loans given to business. Silicon Valley Bank, loans given to business entrepreneurs and the tech space, and those companies didn't make it.
The government came in and gave them money.
Right.
There's a lot of stipulation about that.
The bank never got paid back by the investors, is what we think, right?
Right. Who's eating the debt?
We are at the end of the day.
We are the consumer.
Because
we all are.
Yeah, because when let's say the government comes and saves that bank, like happened in 2008, right?
Correct.
They got bailed out. The big banks were too big to fail, quote unquote. Quote unquote.
Well, there were a lot of people, including me, we weren't happy when we heard that, the administration had bailed out these banks. Why?
Right.
These were multi-million-dollar investors. They took a bad shot. Why?
And then on top of that, they get bonuses. Some of these C-suite
something's wrong.
Get bonuses after the bailing out. History repeats itself.
Yeah.
And who said this? Those who do not remember the past are condemned to repeat it.
I'm not
Was
sure.
it Roosevelt?
Maybe.
Let's look that up real quick.
Mm. But in the midst of all of this mess, right? There's opportunity out there. You have to go out there. It's a little harder to find them, but they're out there. And if you want to progress and move forward, you got to get out there and talk to a lot of people and get creative. You have to get creative. I am a big proponent of carrybacks. And so what do? You try to find someone that has a property. They're tired of managing it. They're tired of living with tenants or handling tenants. And you get creative on something like that where they can potentially be the bank. You figure out a proposal that helps both buyer and seller, and boom, there's an opportunity for people. Because there's always going to be opportunities out there. Always.
Oh, absolutely.
You can't, there's a lot of stuff going on in the market, but you can't let that take you down. You just can't.
You got to just find another way. By the way, I looked it up. Those who cannot remember the past are condemned to repeat it. It says George Santayana, and then also Churchill had something similar.
Oh, okay.
But that's why we're positive people, and we're always looking for an opportunity, and there'll always be an opportunity. Unfortunately, people will get hurt in that process. It will lead to other opportunities. I remember in 2009 when we were marketing the insurance business at the time, you and I together. I remember going to these real estate boards where they were pitching real estate owned properties, REOs.
Yeah.
And you had REO specialists that would come out and they would get a portfolio of properties that the bank had to unload because the bank isn't going to sell those properties.
They didn't want to deal with that. Yeah.
They gave it to an agent like you and said, here, sell these 10 properties. Remember?
Of course.
And so these properties were going for an extreme discount.
Right.
And they were a little bit of a pain in the butt because the bank had to approve, I believe, the offer. You would submit an offer and the bank would have to go and approve, hey, because more was owed on it than what they were selling it for.
Correct.
The bank was taking a loss.
Yeah. Yeah. They
But
were
then
writing
they got
it
bailed
off.
out, so I don't know if they were really taking a loss. But
The idea here is the market, is it a challenge? Yes, it's a challenge. Do we have to make more offers to get the property you're looking for? Yes, you do. Is it more difficult? Yeah. But it is the nature of the beast. This is what we live in. So you got to find a way.
yeah,
And if you stay steadfast, okay, you look at the market, you figure out the ins and outs of it, you'll find a way in which to prosper.
and I don't think anybody knows. Like we're fans of Graham Stephan
Yes.
and some of these guys online that have great content, but they've been talking about a crash for years. And I think that the negative of that could be that it's the boy that cried wolf to a certain extent. You're talking about a crash so much. People that eventually you'll be right.
Yeah, like they say, even a broken clock is right twice a day, right?
Yeah.
So,
But
yeah.
my fear, let's say, would be that somebody gets that information and freezes. And decides not to pull the trigger, decides not to make a move in life because of certain information or that is saying, oh, there's a crash tomorrow. Because even in the crashes, some people did get hurt, some people weathered it.
Well, it was difficult, I'll tell you that. Especially if you have bought, for example, I had bought some commercial property. You traditionally put a higher down payment, and then I would see my down payment because the value of my property was decreasing in price. Okay? And, I was still making the mortgage payment on them, but what was going down? Well, what I saw dissipate away into oblivion was my hard-earned down payment. Okay? And in a couple of cases, they chewed up the entire down payment, which is 1/3 of the cost of the property.
Wow.
You know, and so when you look at things that way, your blood pressure starts to increase. You know, and there's a whole mess of other things, because
Yeah.
then if your health gets affected, then you lose a lot more than just the economic output, than
Yep.
just the money. You know, and looking back, you'll say, oh my God, I blew a fuse, right? I had a stroke or something like this because of what happened here. The level of pressure that you can get yourself into, it's intense. So at one point, you need to step back and say, look, this is, what do I do with this situation? And then you just mitigate somehow if it gets to a point where, you know, it's really bad. And don't bet the house, guys. Don't bet the house. You know, go out there, look for opportunities, be careful, evaluate your risk. Are there opportunities today? Yeah. There's a lot more people looking for opportunities today than they were 20, 30 years ago. Because of the onset of the internet, there's a lot of people that have access to a lot more information, and all that's good. Okay?
Yeah.
All that's good.
Yeah.
It just means that you have to work a little harder to find the opportunity that's available before the other guy. Or, how about this thought? Create the opportunity. You create the opportunity by bringing different ideas to
Or collaborate.
collaborate.
You know, that guy who was your competitor maybe could be your collaborator.
Exactly. You know, so
I agree. I think there will always be opportunities.
Always.
There still are today. Like you said, don't bet the house.
don't bet the house.
Look at what, you know, it could still be a good time if you see a good opportunity, but protect
And
yourself and your family by
Do your due diligence. Yeah, protect
Yeah.
yourself and your family.
yeah, because
Yeah.
like you said, and there are countless stories of people who unfortunately lost their home, lost properties, lost the portfolio, maybe lost their marriages, maybe lost relationships, their health, their
We-
mental health.
Yeah, we know a few. In fact, one that comes to mind is this gentleman that I know. He lost millions and millions and millions of dollars, and he's been able to weather it somewhat well. Okay, it still affected him psychologically tremendously, because he's never been back to the position that he was before. But the downside is that his wife of many, many years, his wife of high school, it's on medication now, and it's on medication forever, because she took it very difficult. So, you know, and like that, I'm sure there's a lot of people. So weigh
Yeah.
the risk and the rewards very carefully. You know, we're out there, we're trying to find the deals, and he who looks findeth. So keep your eyes open and try the best you can.
Yeah. Cool.
All right.
Let's see what happens.
All right, buddy.
Thank you.
Thank you.